morning, traders! Welcome to the Elliott Wave Street Update. I'm Juan Maldonado, and we are going to talk about wave counts, Elliott wave counts today in some markets. Don't forget that you can access the whole analysis every day with daily videos, with charts, with education and more on ElliottWaveStreet.com. Then you go to the membership tab here, so it's ElliottWaveStreet.com/membership. And you will find here all the memberships that we offer, Forex stocks, or the full access with all the instruments that we cover on a daily basis. Plus the access to the new Members Academy with educational lessons and all the live market coverage on these markets based on the Elliott wave theory. All right, traders, so let's talk about the euro. The euro has been trapped in this area, which is good for the market, because it's the first time we are seeing the euro with the possibility of changing from bearish to bullish, or at least to have a bigger bull retrace. This scheme that we are seeing, this pattern, is called accumulation on the Dow theory, and mainly it happens because, let's say that the institutions need to fill up a warehouse with euros. So the way to do it is to do it slowly, because if the price is going down, they need to start buying at the bottoms, and once they have their warehouse completed or full, or no more sellers that they can find, they want to buy at cheaper prices, well, the market starts going up, and they are going to use these euros to sell to buyers later, because they are the other part of the trade. So this market moving sideways is good, because when the market is going down like a falling knife, it can continue moving down until it finds accumulation and the price rejects, and that's that could be the reversal, and we can start something new, or at least a bigger retrace. So I believe that's the cycle that we are in the euro, and these legs that we have this first leg up, we have this other leg that is pretty big. You can see that this leg is the biggest. Then we have this leg as well. We have this leg as well. Something that they have in common are that they are really fast. So it's telling that the demand is stronger than the supply, thanks to the price action. Also, it seems that we need to have one more leg down to clean up all the stops that are here. Imagine all the traders that leave their stop loss somewhere here under the lows. If they went long at any place, they should have the stop loss here. So the next cycle is to take all these guys out. So we have a high probability that the euro needs to move under this area, clean up this liquidity, and from there is where we are going to start buying as an aggressive entry, or maybe here as well after a wave 1 and a wave 2. Those are my two main trade plans. One is aggressive at the bottom entry that has more risk, and the second entry is after wave 1 and wave 2 as a test, where I like to trigger there is a safer trade. But the problem is that not always we're having a wave 2. So that's the tricky part, defining if we go with the aggressive or we wait for the corrective, and there are so many factors that we consider when we are making the decision. Of course, in the membership you are going to learn all those details. So that's the big plan on the euro dollar. Let's jump into the S&P that today is falling, but I think I have good news. I think we are gonna bounce soon, and we are going to have a powerful move up. But before that, let me show you what we did last week in the membership. In the membership last week, I shared with my clients this trading setup, and the plan was to trigger the price around the 100 area, and to have a 5-wave sequence. This was before the Fed, so that was my plan, to have there a 5-wave sequence, to have here the bottom of the market, to have then a 3-wave sequence down, right? So that was the plan. Let's see the actual. Let's see if it worked, if not, and what we can learn from that example. So we were here, right, on that chart, and I was looking for 1, 2, 3, 4, 5, right? That was the plan. And we went long here near the 100 area, and look, the price moves up strongly as expected, right? Nice, working nicely over 200 points in our direction, so enough to book some good profits and everything. Tightened the stop loss, managed the trade, right? It was a fantastic distance. But the ugly part, the unexpected part of the setup, started to happen here. This doesn't look like a wave 4, especially after this strong candle down. Something is not looking good. That was the candle that was saying, hey, be careful. And this one, of course, confirmed that this was not right and that the market was building a 3-wave sequence. So there, the chances that we were going to reach a lower low from seeing this price action without the Elliott wave 5-wave sequence was huge. The market moves under the low. We have a little rejection, but fails to close above this high, so above this low. So clearly we don't have any trading setup here. And the market accelerates today to the downside. So let's talk about this setup. Let's see how we can find the bottom of the market, being extra careful, because clearly the big guys are trying to stop hunt as much as possible, to make margin calls, to do a lot of nasty things here to take out as many participants as possible. So look, the plan right now is to have the completion of this pattern. It could test at the 4,000 area. It could actually break out the 4,000 area. But there are two ways to trigger the trade. One is the aggressive. So let's say that the market returns to this area, and there we can go long at the breakout and the close. And the other way is to wait for a clear 5 up and a 3 down. So we can say entry number 1, entry number 2, right? One or the other. The second one is the safest, because we already have the 5-wave sequence on the left. The second one, the first one is more aggressive, and the benefit is that sometimes we don't have a clear wave 1 and 2. You know, so sometimes we have a pretty strong move up that is hard to find a wave 2. So of course each has its benefits. Daily on the membership we cover these topics to talk about the benefits and the risks of and everything of each pattern. And of course there is a third option that I don't think that is going to happen. The probability is low, but still is a probability that we have a market crash and we have the S&P moving 50% or 30% to the downside in a couple of days. For that one, we should see more momentum happening here. We are at a market low, so we should see less demand. We should see weak volume. We should see the prices slowing down. But if the price continues with that behavior, let's say that the next candle is green, is red, huge to the downside, that will open the door for a market crash, because we are not looking for acceleration at the end of the cycle. We're seeing for the prices slowing down and a different behavior that should start looking soon as some sort of wedge formation, right? Some sort of wedge happening here. That's the way the market reverse. Or a nice green candle showing up because the market went down too fast. So those are the scenarios that we are looking here, again with a higher probability bias to the upside in terms of the wave count. And there is something else that I want to share with you this week, and is the dollar, the US dollar. When the US dollar is moving up that fast under this special scenario that we are seeing risk, so mainly what we are seeing is that the big guys, the institutions, are buying USDs and they are dropping all the risk investments. So what could be there in that bag? Bitcoin, let's say, stocks, right? The S&P, all the stocks. If currencies, like the euro, like the pound, all the risky assets, they are dropping in their portfolios, all these risky assets, and they are moving into US dollars. So they have a huge pile of cash, and that's why the US dollar has been moving up so fast. But look, it's slowing down. And finding the top on the US dollar could be this one, or the price can make a higher high, that's fine, and reject. But finding the top of on the US dollar is finding the bottom on these risky assets. Maybe the Bitcoin is a little bit more in trouble than the others, but in the stock market, in the Forex market, that's going to be finding, because once these guys start spending their cash, the US dollar is going to move down. So if they start using that money to go back to the stock market, to go back to the risky assets, this could be a leading indicator. This leg has been good, this one has been good, but look, the reaction after that higher highs. So we are at that point where the market can start reversing if we have the proper signal. That's why it's important to read supply and demand on the S&P or the euro or any market, and not trying to buy the falling knife. Clearly, that would be a terrible idea. But also understanding the money flow, and once the US dollars start to hit the market again, once the investors start moving their USDs to risky assets, that's where we are going to have a high probability bottom of the market. I believe we are pretty close to that situation. I believe we are getting closer to that with this discount on the S&P. So let's see how it plays out. I'm looking now for the entry on the S&P to go long. All right, traders. So that's the plan for this week. If you want to get our fantastic daily Elliott wave analysis here on ElliottWaveStreet.com under the membership tab, you're going to find the plans and all the details about the membership. You can subscribe for your first month trial, just $19, to find out if you like this style of analysis by getting the charts every day and the videos and all the live market analysis. And if you have questions, let us know. Have a fantastic start of your week. I'll see you soon. Take care. Bye-bye.